By the time you read headlines about interest rates dropping, the rich have already made their moves. They don't wait for confirmation. They've been preparing for months, ready to act the moment rates shift. Here's the part that matters for you. In this video, I'll give you a 3-part playbook: offense, defense, and efficiency. You'll see the exact steps, micro actions that can start in the next 24 to 72 hours that make falling rates work in your favor, even without millions in the bank. If you're ready for practical steps, type "ready" in the comments. So why does it often feel like everyone else gets ahead when rates drop? It often feels like lower interest rates should bring immediate relief, yet daily life doesn't reflect that promise. Headlines frame rate cuts as good news: cheaper borrowing, strong growth, easier access to money. But your bills don't shrink overnight, and groceries don't suddenly cost less. The truth is that the first effects play out in capital markets, not household budgets. Stocks can surge within hours, crypto shows sudden life, and housing demand picks up almost immediately. Meanwhile, families waiting for a drop in their mortgage payments or credit card balances see little change in the short term. That delay creates the perception of a gap between what's announced and what people actually feel. Here's where the frustration builds. On one side, institutions react in real time, shifting their money into assets that now cost less to finance. On the other, everyday households wait weeks or months to spot even the smallest difference. It's as though two timelines are running in parallel, one racing ahead and one crawling slowly. And by the time most people notice, the best opportunities are gone. Think about it like biking uphill. Every turn of the pedals feels heavy and slow. Then suddenly, the hill becomes a downhill slope. Those already pedaling with energy shoot forward effortlessly, while anyone who hadn't started is left far behind, struggling to pick up speed. That's exactly how rate cuts play out. Momentum only works if you were in motion before the slope changed. This is what I call the silent gap. It's the time between when the official news drops and when individuals can realistically act. Capital moves fast. Institutions can redeploy millions into housing or corporate bonds within hours of a Federal Reserve pivot. They don't wait to run the numbers. They've already done the work ahead of time. That's why gains seem to compound overnight. The average household, by contrast, may still be weighing whether their bank will eventually update loan terms or credit card rates, and that delay leaves them behind from the start. The silent gap is not about unfair rules. It's about readiness. Those who plan in advance treat the official announcement as a green light to execute steps prepared months before. Most people, though, sit tight until they see visible proof, a change in their bills, a headline about home prices, or confirmation from a lender. By then, markets have already shifted and the biggest gains are locked up. So the real distinction isn't access to better news, it's timing. When rate cuts hit, the early movers position themselves to ride the slope faster, while late movers are forced to chase prices that have already jumped. That's why it feels like the game is tilted, even though the difference usually comes down to planning and decisiveness, not privilege. The question for you is, do you want to be the first off the starting line or last? Because here's the key. Wealthy investors don't wait for the announcement at all. They prepare their moves months in advance, building the capacity to act the moment conditions shift. And understanding what that preparation looks like is the next step. Wealthy investors follow a hidden playbook, one that starts long before the Federal Reserve announces a single word. Instead of treating rate cuts as the signal to begin planning, they see them as confirmation to act on groundwork already in place. Preparation is the engine, and the steps are clear. They hold liquidity in the form of dry powder, polish their credit, and set up trusted lenders or brokers so they're ready the moment conditions shift. Dry powder means something very specific: cash reserves or unused credit lines kept ready to deploy. It's not an abstract idea, it's liquid capital that can move the second opportunities appear. By keeping cash parked or credit-free, The wealthy don't scramble when announcements hit. They know which deals, properties, or companies they want, and they can act instantly because funding is already secured. At the same time, they maintain strong credit profiles by paying down high-interest debt, lowering utilization, and keeping steady payment histories. Lenders prefer safe clients, and when money becomes cheaper to borrow, those who look reliable are first in line to access it. The difference isn't special access. It comes down to organizing ahead of time. By the time rate cuts arrive, they already have their ammo, their spotless financial track records, and the relationships with people who can execute fast. That's why they move while everyone else is still wondering whether conditions really changed. They plant before the rain. Consider how this looked during past cycles. Before mortgage rates dropped visibly for most households, wealthy buyers had cash ready to purchase discounted properties. By the time casual buyers noticed rate cuts, prices had begun to rise as institutional and wealthy players had already secured prime assets. From the outside, it seemed unfair, but what actually made the difference was timing paired with preparation. Money at the ready, credit lined up, and a list of targets drawn up in advance. Now the obvious question is, how can you adapt this playbook without millions on hand? The truth is, you don't need a massive balance sheet to mirror the same structure. You can build your own version step by step. Start with a small opportunity fund. It could be a few $100s tucked aside and not touched, waiting for the moment rates shift. Then build your reliability in your credit file, automating payments on time and working to lower outstanding balances so utilization doesn't drag you down. Finally, keep your eyes open ahead of time. Scout the opportunities you'd move on, whether that's neighborhoods you'd consider for a refinance, tools you'd invest in for a business or side hustle, or even courses you'd take to expand your earning power. These are simple, repeatable actions, and they mirror exactly what the wealthy execute at larger scale. Saving reserves, polishing a credit profile, and scouting targets may sound ordinary, but ordinary is what actually closes the gap during rate cuts. Because when conditions change, opportunity favors those prepared to act, not those waiting for hints of proof. So what looks like a secret rule book is really a method anyone can follow. Handle manageable debts now, improve your credit reliability piece by piece, keep even modest liquidity available, and know where you'd move if conditions shift. These steps don't guarantee wealth overnight, but they set you up to participate at the same moment rates open doors. And once you're lined up with reserves, readiness, and clarity on your next move, what matters most is how you channel the cheaper money that flows into the system. That's where the 3 levers of wealth come into play. 3 levers: offense to grow, defense to protect and redirect, and efficiency to build systems. These are the tools that determine whether falling rates just reduce a bill or actually create lasting wealth. Think of them as handles you can pull, each with a specific purpose, and together they give you real control when money gets cheaper. The first lever is offense. This means using lower borrowing costs to expand your earning power. At the smallest scale, it could be taking out a low-interest personal loan to fund a certification that boosts your salary or to buy equipment for a side hustle. Wealthy investors do this with businesses and real estate, but the same principle applies when you use cheaper capital to accelerate income growth instead of waiting years for it to trickle in. The second lever is defense. Here the focus is on restructuring debt while the conditions favor you. Refinancing a car loan, rolling over high-interest credit card balances into lower-rate options, or locking in a better mortgage can all reduce monthly outflows. But the critical move is to redirect the savings. If lowering a loan payment frees $100 a month, directing that amount into an investment account transforms a short-term relief into long-term security. The wealthy build another layer of wealth this way, while most people allow the extra to disappear into daily spending. The third lever is efficiency. This is about putting small systems in place so money consistently works for you. Automating transfers into a low-cost index fund, enabling round-up investments on purchases, or setting up auto-pay to avoid late fees ensures that every extra dollar gained from rate cuts flows toward growth. Small habits, repeated month after month, separate those who passively drift through lower rates from those who build momentum with them. Pulling these levers separately is powerful, but combining them is what truly compounds results. Imagine refinancing a car loan. Defense. Taking the $100 in savings and automating it into an index fund. Efficiency. And at the same time using a modest, low-cost loan to fund an online certification that boosts your income. Offense. At this scale, you're not speculating in markets or buying property. You're reshaping your personal structure so that every change in rates multiplies. That's how ordinary households can use the same playbook as the wealthy. For most people, that integration feels like a breakthrough. You realize lower rates aren't just about borrowing less expensively, they're about using that shift to engineer growth from multiple angles at once. By reframing payments, automating discipline, and expanding income capacity, you build a system that captures the benefits instead of waiting for them to filter down. The simplicity here is crucial. You don't need millions or complex strategies. You need the discipline to pull each lever with intent. When money becomes cheaper to borrow, you can either absorb that change as background comfort or redirect it into tools and habits that make you stronger. Wealthy investors grow because they treat a rate cut as an opportunity to rewire their system. You can do the same, even with modest amounts, if you act deliberately. And once you see how offense, defense, and efficiency work together, something else comes into focus. The biggest difference isn't only in the numbers on your accounts, it's in how you approach opportunities themselves. Because what determines whether you stay still or move forward isn't just the levers you pull, it's the mindset you bring to them. What really separates outcomes when rates fall isn't just the mechanics of lower payments. It's the mindset shift from surviving to expanding. Most people hear about cheaper borrowing costs and immediately think in terms of short-term relief. A lower credit card rate feels like a breather, or a smaller car payment feels like the pressure has eased. That relief is real, but it's also temporary. The wealthy, however, interpret the same environment as acceleration. For them, rate cuts aren't about catching up, they're about moving faster. Here's the challenge I want you to take on. Say out loud, or even drop it in the comments, do you see debt as a trap or as a lever? For most households, debt feels like a burden that must be crushed as quickly as possible. It's stressful, it limits freedom, and every dollar sent to it feels like holding your future hostage. But when rates fall, debt changes character. A loan that might have been risky at 8 or 9% can become a powerful strategic tool at 4 or 5%, provided it's used with discipline. That doesn't mean taking reckless bets. It means recognizing when cheaper terms turn a liability into controlled leverage. For example, a loan used wisely to consolidate higher interest balances or to invest in a certification that raises income can be a net positive instead of a dead weight. This is the clearest line between surviving and expanding. Survival mode looks for reduction in tension, smaller monthly bills, some breathing room, a little cash left over. Expansion mode asks a different question. How can I use this new room to strengthen my position for the long term? One group collects short-lived comfort, the other builds durability, assets, and momentum. Both experience the same rate cuts, but only one builds systems that continue compounding long after the event. Another way to think about it: capital reacts instantly, but perception is slower. Markets surge within hours because large players act immediately. Households hesitate. They second-guess, they wait, they wonder if it's too soon. By the time the average person feels confident, much of the early advantage has already been absorbed. That lag is where opportunity evaporates for most people. But if you've been preparing, building credit reliability, reducing expensive balances, and holding reserves, the drop in rates feels less like background noise and more like a clear green light. You don't need certainty before moving. You already know the steps to execute. Preparation is what makes expansion possible. Without it, falling rates produce little more than a sigh of relief. With it, falling rates multiply the path you've already chosen. Imagine facing the next rate cut with high interest debt already out of the way, with your credit profile tuned up, and with a small reserve set aside. Suddenly, you're not depending on conditions to rescue you. You're setting conditions to magnify what you've already set in motion. This mindset shift is about moving from reactive to proactive. Instead of saying, "I'll feel better once the system changes," you begin saying, "When the system changes, I'll be ready to act." Your environment doesn't dictate progress, it amplifies preparation. Rate cuts don't automatically carry you forward. They accelerate the exact direction you're already heading. And here's one simple behavioral habit to anchor that shift. Before you spend any savings freed up from lower payments, pause and write down the 2 ways that money could build future growth. Maybe it's adding to your emergency cushion. Maybe it's funding a new skill. Maybe it's starting an automatic investment. The act of naming those options makes it much more likely you'll choose expansion over comfort. Because once you make that change, rate cuts stop being background noise and start becoming signals. They're no longer just relief, they're multipliers. And that leads directly to the bigger picture: what falling interest rates really mean for those who are ready and what happens to those who aren't. Rate cuts don't create wealth by themselves. They only open the door for those prepared to step through. The core is simple. Use the 3 levers: offense to grow, defense to protect, and efficiency to build systems to turn lower rates into lasting advantage. Here's your micro action for the next 24 to 48 hours. Set one automatic $50 transfer into a low-cost index fund, or start a small $100 to $500 opportunity fund. Small, deliberate steps are how you mirror the same playbook the wealthy use at larger scale. Wealth flows toward readiness. Start building yours today. If this framework was useful, like and subscribe, and drop a comment with the lever you'll pull first.